Welcome to this explainer. Today, we're taking a leap into the future to map out a totally revamped strategy for earning passive income with cryptocurrency in 2026. Look, if you've been following the digital asset space, you already know that simply buying a coin and hoping it goes up, that's not the only way to build wealth anymore. The landscape is maturing, and we're going to break down exactly how your digital assets can actually work for you, literally generating revenue in the background while you go about your day. Let's get into it.
All right, here's our quick roadmap for today. We'll start with the 2026 income strategy, then move into staking, earning while holding. After that, understanding yield farming, exploring other income methods, navigating the crypto risks, and we'll wrap it up with best practices for beginners.
Okay, part 1, the 2026 income strategy, preparing for the future of digital wealth. Basically, as we look toward 2026, the gap between traditional finance and decentralized finance is closing incredibly fast. For a beginner in a developed economy, assuming you've got solid internet and some capital to start with, the opportunity to generate passive income has genuinely never been this accessible. But, and this is a big but, it requires a very specific, structured approach.
Moving on to part 2, staking, earning while holding, the foundation of crypto passive income. This right here is your bedrock. For most people, it's absolutely the easiest starting point for our expedition.
So, think of staking a lot like locking up your funds in a traditional high-yield savings account, or maybe buying a certificate of deposit. You know the drill, but here's the really wild difference. When you stake your crypto, you aren't just lending it to some bank to do whatever they want with it. You are actually participating directly in the security and operational consensus of a blockchain network. By mathematically proving that your assets are locked up, the network, or the validator you delegate to, basically says, okay, we trust you to help verify transactions. And because you're providing this crucial security service, the protocol automatically pays you in more cryptocurrency. It's this beautifully designed incentive structure where just holding the asset literally protects the system that gives the asset its value in the first place.
Now let's step it up a notch with part 3, understanding yield farming, cultivating higher returns in decentralized finance. If staking is your safe, reliable foundation, yield farming is where things get a bit more active and honestly, potentially a lot more lucrative.
Here's the core dynamic at play. Yield farming essentially lets you act as the bank. You provide the liquidity that other people need to trade. Think about it. In traditional finance, a centralized bank sits in the middle of a trade, takes your money, hands over the new currency, and quietly pockets a pretty massive fee. But in decentralized finance, or DeFi, there is no middleman, zero. Instead, we have these things called liquidity pools. When you deposit your crypto into these pools, you are the one literally earning those trading fees as other users come in and swap assets against your liquidity. You get to keep what the bank used to take. How cool is that?
But let's take a second to compare these two side by side, because understanding the difference is absolutely crucial. Staking, that generally offers lower risk and lower reward. You're just securing a network. Your tokens stay on their native blockchain, and the mechanics are pretty straightforward. Yield farming, on the other hand, is a totally different beast. It introduces a lot more complexity and risk, but for potentially massive returns. You're out there interacting with various DeFi protocols, locking your tokens into complex smart contracts, and navigating the market swings of multiple assets all at once. So while staking might give you a nice, steady, predictable percentage yield every year, yield farming can offer exponential returns. It just demands way more of your attention and comes with a seriously steep learning curve.
All right, part 4, exploring other income methods to really expand our 2026 strategy. Because, let's be real, you never want to put all your digital eggs in one basket.
So beyond staking and farming, what else is out there? Well, you can lend your crypto out for a set interest rate. Just like a traditional loan, you provide your assets, a borrower puts up collateral, and boom, you earn a steady stream of interest. Then you've got dividend-earning tokens. Some crypto projects operate a lot like traditional companies. If you hold their native token, you literally get a proportional cut of the revenue that platform generates. And finally, there's liquidity mining. This is a neat little subset of yield farming where, on top of those trading fees we just talked about, the platform actually gives you bonus tokens just to incentivize you to stay with them. It's kind of like a bank handing you a free toaster and a cash bonus every single month just for keeping your money in their vault.
Okay, so with all this potential, we have to ask, is this a guaranteed payday?
let's hit the brakes for a second. Before we get completely swept up in the dream of early retirement and endless passive income, we really have to ask ourselves if this expedition is safe. It is so incredibly easy to look at those high percentage yields and get greedy, but the reality of the digital frontier, it's a whole lot more nuanced.
Which brings us to part 5, navigating the crypto risks, the hazards of the digital frontier. We need to look really closely here. Because guys, a week in crypto can sometimes feel like an entire year in traditional finance. The speed of innovation is basically only matched by the speed of the potential pitfalls.
Here is the sober, unfiltered reality. Extreme market swings, technical bugs, and shifting regulations are very real threats to your hard-earned capital. Let's break down the 4 big ones. First up, high market volatility.
The asset you're earning 10% on could easily tank 20% overnight, completely wiping out your gains.
Second, smart contract vulnerabilities. Because DeFi relies entirely on code, if a hacker finds a tiny little bug in the smart contract holding your liquidity pool, they can drain the whole thing. Third, unpredictable regulations. Governments in developed countries are still trying to figure out how to tax and regulate this stuff, which could totally blindside your strategy unexpectedly. And finally, platform insolvency. If the project just goes belly up, those shiny tokens you've been earning, they could drop straight to zero. Let's move to our final section, Part 6. Best Practices for Beginners. Your 2026 Crypto Survival Kit. If you're going to navigate these waters safely, you absolutely have to equip yourself with a strict set of rules. You cannot afford to walk into this landscape unprepared. By meticulously sticking to these best practices, you'll build a rock-solid, cautious foundation. Step 1. Do your own thorough, independent research. Please, do not just blindly follow influencers online. Read the project's actual documentation and understand exactly where that yield is coming from. Step 2. Start small. Never, ever invest more capital than you can afford to lose completely without it affecting your daily life. Step 3 is diversify. Mix it up. Put some funds in low-risk staking, maybe try a tiny fraction in yield farming, and keep a chunk completely offline in a cold wallet. And Step 4, only use reputable, audited, and secure platforms. Chasing some brand new, no-name platform just because it promises a massive yield? Yeah, that's almost always a recipe for disaster.
So, as we wrap up this explainer, I want to leave you with one big question to chew on. Are you financially and fundamentally ready to navigate the crypto landscape of 2026? The tools we have now to build digital wealth are incredibly powerful. They can literally turn you from a passive consumer into an active participant and liquidity provider. But, with great power comes the responsibility of education and risk management. Take the time to really digest the concepts we talked about today. Respect the risks, and ask yourself, are you truly ready to be your own bank? Thanks so much for hanging out with me on this deep dive into the future of passive